Hey everybody, this is Scott Arnell, and welcome to this episode of the SRI 360 podcast, where in every episode I interview world-class, sustainable, and responsible investors, executives, or entrepreneurs who are driving positive change in the world while achieving market returns. And I do this in order to bring you the lessons that they've learned along the way from their investment activities and their experiences, and to find out what they are actually doing and how they are doing it so that you can have better insights into the different SRI investing strategies that are actually being done today and what they're actually doing right now, and doing it across many different asset classes. And hopefully this will help you invest in a more purposeful way and to invest for positive impact for a better world through your investment activities. Today, I'm speaking with Bond, Simon Bond, and that's spelled B-O-N-D. And in this episode, we're going to be focusing on social impact investing through publicly traded fixed income instruments, more commonly referred to as bonds. As Simon explained to me, with his surname, he had two choices in life. Either he was going to be working in bonds or become a spy. At least officially, he has chosen bonds, and therefore this episode is shaken, not stirred. Simon is the Executive Director of Responsible Investment Portfolio Management at Columbia Threadneedle Investments, based in London, which is the asset management arm of Ameriprise Financial, who has total assets under management of $1.4 trillion as of the end of 2021. In December 2013, Simon conceived of and launched the Threadneedle UK Social Bond Fund, which was the first daily liquid fixed income impact fund in the UK designed to deliver social outcomes and financial returns. It does so by investing in a diversified portfolio of fixed income securities with social impact criteria. In 2017, Simon went on to launch the Threadneedle European Social Fund, targeting social developments and projects with positive outcomes for individuals, communities, and society, predominantly in geographical Europe. Both funds apply traditional corporate bond investment acumen to an innovative approach to social investment. Simon started the social funds with an initial capital of approximately $5 million about 9 years ago, and the assets under management has grown to over $1 billion. Simon has over 3.5 decades of experience in the fund management industry and is a recognized specialist in corporate credit. He is a chartered fellow of the Chartered Institute for Securities and Investment. He holds the Investment Management Certificate and the General Registered Representative Certificate. We will be having a far-reaching conversation today where we discuss Simon's early career and how 30 years ago he got into bonds and first discovered what he calls finance's soft side, where you could not only expect a financial return for the risk you were taking, but you could also produce some benefits to society. How about 9 years ago, he launched his first social fund in the UK and ended up partnering with the Big Issue in the UK as the fund's social partner to provide oversight on the social outcomes delivered by the fund's investments. Simon speaks to his approach to portfolio management, which he built around positive inclusion, evidence-based approach, and engagement with management. And this last point is important because debt is often overlooked in impact investing, because investors often feel you can't engage with a company like you can when you have an equity position. And I believe you will think differently about this after listening to today's episode. Simon discusses how they are accountable for outcomes and how they map every bond to 8 social outcome criteria that they've established. He goes into some detail how he constructs the fund's portfolios, and he provides some concrete examples. We discuss greenwashing and a whole lot more. You can find Simon on LinkedIn and on the internet at columbiathreadneedle.com. Speaking with Simon was very informative for me. I really enjoyed it, and I think you will enjoy it too. And now, please meet Bond, Simon Bond. If my intelligence is right, I'm the last thing between you and vacation, which isn't put me in a very good position.
You would think that, actually, but it's not quite the case. But, one or two things in the market going on, but actually worse than that, we were going to go sailing. Originally, we wanted to go sailing in the Greek islands, couldn't do that. Then we said we'd go sailing in the Solents. That actually would still be possible, but then my daughter, my crew, fell off her skateboard and broke her arm. So that's rather scuppered that. I've got nobody to crew with me. We're probably going to make it up as we go along.
I guess that qualifies as life is what happens when you're planning to do something else, right?
Yeah. To be honest with you, you can never rely on the weather when you're sailing anyway. So you've got to get into this mindset of take it as it comes. The first priority is England versus Scotland this evening. One of my colleagues has driven back to Scotland from London to watch the game. It's that extent of commitment, really, that he wanted to be surrounded by his countrymen, not by the opposition in London. And so he's driven all the way back to Scotland to watch the game. At the same time as half of Scotland seems to have descended upon Trafalgar Square and Piccadilly Circus overnight. So there's a lot of travel going on because of this. It's just important in its own right. It's England versus Scotland. It's the oldest international football game in the world.
I suspect you're from London, right?
I'm from northeast London originally.
So you're definitely rooting for England then tonight.
I'm rooting for England. Having said that, if Scotland were playing anybody else, I'm British as well, so I would be very pleased the Welsh won their game the other day. But when it comes down to actually playing England versus Scotland, I want Scotland to lose, and if it was the same with Wales, etc. I don't think it quite works in reverse. I think there's less prevalence from the Scots and the Welsh to support England if they're playing other side. My love of football actually does extend into the social side of things, because I'm a big fan of Tottenham Hotspur, and who you would have heard of, Leyton Orient, who you probably wouldn't. But when they were building their new stadium, I was actually looking into the social effects, how this could be a catalyst for regeneration in the area. And I was looking and talking to businesses, cafe owners, that sort of thing. I was thinking to myself, I'm here to attend a football match. I can't leave this social stuff behind me. I've even gone to the extent of knowing that the Sainsbury's supermarket that they built at the end of the new ground, the foundation actually trained the local people not to get the job, but to actually train them to do the interview and to provide them with the suits and the apparel, those kinds of things. So the foundation did some really great work in making sure that local people, from deprived people that didn't necessarily have the wherewithal to go about the interview process and the application, etc., that they were the people that got employed in the Sainsbury's supermarket. I can't go anywhere, even to a football match, without kind of taking this kind of impact world with me, this social aspect with me.
Let's get into all that. But before we start drilling down on that, you've been deep in the financial industry for over 3.5 decades, I think.
35 years in financial markets, 30 years specializing in corporate bonds. And with my name, it was inevitable, wasn't it? Yeah, I started off in equities, but no, I was always going to end up in bonds, wasn't I? It was either that or I was going to be a spy. So with my name, there were two choices.
Well, I was going to ask you if you believe in nominative determinism.
There's got to be something in it, hasn't there? But I mean, the real reason actually was I was working at Hambros Bank in the investment management department. I was working for Peter Hill-Wood, actually. He was the then chairman of Arsenal, which is the enemy in North London. But I was working there in the investment management department, and I was what they used to call a desk assistant. And these days they've had different names, but effectively it was the guy that went and did all the stuff and asked all the stupid questions. And I was working predominantly for the equity fund managers, but there was one bond fund. And of course I was the young, enthusiastic, go anywhere, do anything kind of guy. And so I was the one that sort of picked it up and said, what are these bonds? What is accrued interest? How do you work it out? Why is this Warburg sheet or whatever it was at the time? Why can I not work out the number that's on that sheet? And you go and discover they're working it out to the settlement date, not to the date of the transaction. All those kinds of things. I always say I got where I am today by asking stupid questions. And I still reserve the right to ask stupid questions because this new responsible investment, ESG world, etc. I can still ask the stupid questions like I used to when I was a 21-year-old. But effectively, I became the bond market expert because I knew a little bit more than the people around me. And by doing so, it's the one-eyed man in the world of the blind men kind of syndrome, really. I became the expert. And so anything that was to do with bonds, supporting bonds and bond fund managers, and it was David Tapper at the time, he was on a different floor. But I became the expert in bonds just by the fact that I was the young guy who was enthusiastic and asking, I like to know things, basically. And on the strength of that, I got a job at Provident Mutual. I ended up at the same job, but supporting the bond desk. And at the time, the bond desk consisted of 3 people and me. These were the days. And that really was my entree into particularly what you might say front office. So that was really my entree into moving over from being a desk assistant to an analyst. And at the time, an analyst was just the precursor to assistant fund manager, deputy fund manager, senior fund manager. And it was the beginning of that process. And that's really how I got into bonds. But my name maybe had something to do with it. Maybe it was predestined, these sorts of things. But the great thing about social investment is you do have to go back all of those 30 years. to when I was a young, fresh-faced, clean-shaven analyst 30 years ago. The first entity that I analysed as an analyst at Provident Mutual was Peabody Trust Housing Association. I looked at their debenture new issues. And of course, that gave me the impression that this hard-nosed financial approach actually did have its soft side. And you could actually feel good about going to that meeting and about the effect, in addition to the financial return that you would expect for the risk that you were taking, could also see these benefits to society. And of course, Peabody himself, he was the original founder of what became Morgan Grenfell. I think it was originally Morgan Peabody or Peabody Morgan. He came over to London and became the great Victorian philanthropist in 1865 odd. And he left the legacy of his trust for the benefit of the London poor. And indeed, through the Housing Association and through the Peabody Estates that I pass on the train every day, the one in Hackney. And indeed, I passed his statue at the back of the Royal Exchange every day on my way to the office and from the office. So that's really where the kernel of the idea came from. And if you like, if I have a hero, and my hero is definitely my dad, but if I had a hero in that kind of outside the family sense, it probably would be George Peabody, because of the fact that he was the original Victorian philanthropist and he left this legacy which continues to deliver today. So they're developing the Thamesmead estate, Peabody Trust, big development for social housing in southeast London, still having an effect today. And so really, when Big Issue came through the door around about 9 years ago and said that they wanted to direct people actually towards a product that shared their values, and they mentioned social housing associations, etc., I was brought into that meeting on the basis that not only was Peabody Trust the first entity, and I say entity because it was established by an Act of Parliament, it wasn't a company, it preceded company law. I was brought into that meeting on the basis that I can bore for England on the housing associations. And that's really how it started, because once they got me in the meeting, then out came all the frustrations about what the bond markets used to do, could be doing, should be doing, and all the experience that I had. So the way that we actually manage what are effectively impact funds really comes from, if you like, a bond market expert's view on how the bond market, his own asset class, can best deliver for society. It's not from an RI specialist's view of how you can overlay RI onto existing ways of managing funds. And so when I described how the bond market has a much, much wider spectrum of opportunities of entities that are doing good for society, from charities, not-for-profits, housing associations themselves, local authorities, special purpose vehicles in terms of infrastructure and those sorts of things, all the way down to supranationals and agencies, etc. You simply can't invest in those entities through common equity, but they're all issuing bonds and they all should be doing good and be focused on doing good for society. So the spectrum of opportunities was so much greater. And the other thing in the bond market was that the ability to target social impact, as it turned out, to be able to follow the money through to the use of proceeds was so much greater, because with equities, it's much more sustainable outcomes. And yes, we look at that in terms of sustainability when we're buying a secondary issue in the bond market. We talk about outcomes, positive outcomes, beneficial outcomes. When we buy a new issue, that's the point at which the borrowing entity, the issuing entity, borrows the money and spends that money in society. And that's the point and the location where that impact occurs that we analyse. So effectively, that was what I was saying to them. You can follow the money through to the use of proceeds and you can determine the good that use of proceeds does for society. So the additionality, the focus on deprivation. And also, of course, you want to see some of the impact reporting, some of the evidence coming back as well. And so that really was the history of where the idea came from 30 years ago, how it turned itself into what became a fund, and how the Big Issue then became the social partner when we launched the UK Social Bond Fund just over 7.5 years ago. The rest of it is just really building on that and how we do it and how we approach it. But the idea really was from good old George Peabody, the American Victorian philanthropist.
Okay, I'm going to ask you one thing that even predates your Hambros time, because I'm going to forget it. You list on your LinkedIn profile under your education, Forest School. And what I know of Forest School is it's more like a educational philosophy or something, as opposed to a school, but is there a school that you went to called
Yeah,
for?
it's the only public school in East London. So it's actually in Upper Walthamstow. They describe themselves as near Snaresbrook, but it was effectively a school for self-made men. And my father left school at 14, 1939, he was 11. His education from the age of 11 to 14 was 1939, bombs falling everywhere. He would go into school on a Monday morning, pick up a book, take it back, read it, and go back into school on the next Monday and give the book back. So his philosophy is absolutely essential into everything that I live and breathe. In fact, he's no longer with us, but he was education, education, education. That was the most important thing. It was very much the give a man a rod and teach him to fish kind of philosophy. So he put a huge amount of effort into that. But this is, in fact, a school called Forest School. It dates back. In fact, there's a link. It's a football school, a soccer school. We're original members of the Football Association, and they're the only school to have participated in the FA Cup at both the old boys team and the school team participated in the very, very early days of the FA Cup. So they don't play rugby. And this is in East London. So, you tend to find rugby is very much South and West London. Yeah. So that philosophy and that very much his aspirational attitude, because he was the son of a train driver, an engine driver, Casey Jones and all that kind of stuff comes to mind. But he was very much an aspirational character. He went into the Navy. He came out of the Navy. He was working on the railways, which is what his father did. And that's what people did at the time. And he just wasn't happy with that. He was an academic. He had not passed the 11 plus, and I don't know why. He was very much an academic. And he then went for a job in marine insurance on the basis that he'd been in the Navy. And it was a job that was advertised up to the age of 28. He was 27 at the time, and they misprinted it. It should have said 25, and they misprinted it as 28. And bless them. They said, okay, it's our mistake. We got it wrong. We will interview you, even though you're too old. And he got the job. And from there, he took professional exams. In fact, he took school certificate. This was all evening classes, school certificate, professional exams. He then became a fellow of the Chartered Insurance Institute. He was very much an academic. That the school system had, in fact, it was the war, wasn't it? And the social hierarchy at the time had let him down. But he was a very, what you call, aspirational character. And I always remember asking him, what class are we? We learned about the class system in school, I think, and I came back and said, what class are we? I remember he said to me, we are lower working class. And he said it with there was something about the way he said it. And it was the fact that he could say to his son that he was middle class, that he'd risen above working class. He could now say to his son that we were middle class, but he couldn't say middle class. He had to say lower middle class. I must have been 7, 8, and I remember the look in his face and the pride in being able to say he had now aspired to be able to say to his son that we were lower middle class. So aspiration, education, giving back, and society and those sorts of things are fundamental to my outlook.
That's extraordinary. All right, maybe you could just describe to me at the 30,000 foot level, what's your current role? And how do you describe what you do? And then we'll move into Columbia Threadneedle.
So originally I was managing about 8 billion of pension funds, life funds, annuity funds. I've been managing corporate bonds, as I say, for 30 years. But if we go back to 9 years ago when I met Big Issue, I was launching the fund at the same time as being on the investment grade desk and doing all those things as well. And it became fairly clear around about 5 years ago that this was something that I wanted to do. And we were in the throes of thinking, can we extend this to other products? Can we do a European version of the fund, et cetera, et cetera? And so at that point, 5 years ago, I moved away from the investment grade desk and then went to sit physically with the responsible investment team, who were a growing team at the time. But again, it was 3 people. I always seem to end up with teams of 3 people that, in addition to me, that is, went to sit on the responsible investment desk. And now this is a team of, I don't know how many we've got, 16, is it? I think 18. I can't remember exactly how many responsible investment people there are now. But I went to sit with them and we backfilled my role. So I could pass on the life funds, pension funds, annuity funds. I always said temporarily, because I always thought actually that these types of funds, these institutional mandates, they would catch me back up. I would not be leaving them behind forever. And in fact, I was managing Zurich's money and that they very much are catching me back up. So that these kinds of concepts, I was just a little bit ahead of the game. And so I went to sit on the responsible investment desk. The launch of the fund some 7.5 years ago was the start of it. We adopted a social partner. The social partner's role was to, one, define the 8 areas of social outcome that we are targeting. What is social was a question for the social partner, the experts. Big issue defined those 8 areas of social outcome. We established an oversight committee called the Social Advisory Committee, which, if you like, replicated what you would see from a risk committee on the financial side. There's always a financial side, there always ought to be an equivalent for the social side. So if you've got a risk committee for holding your feet to the fire on the financial side, you should have something equivalent. And that's the Social Advisory Committee, which is the second point. The social partner touches the process because 3 appointees come from the social partner, from that Social Advisory Committee. One is an independent, which is John Hale, who used to be the bond guy at the Association of British Insurers and used to run the special committees and used to facilitate the restructurings and the dealings with bondholders. Now retired. He's our independent appointee and indeed chairman. And only 2 from Columbia Threadneedle, 2 appointees from the fund manager, myself and Ian Richards, the head of responsible investment research. So we're outnumbered, and quite rightly so, and we're outvoted, and quite rightly so. And that provides an oversight on the promises that we make to investors on delivering the social credentials of the fund in the same way that the risk committee would do on the financial side. And the third area that they touch the process is once a year, and actually we're approaching the mid-year point at which we take a snapshot of the fund, and then they will produce an impact report on the fund, which I'm sure can send you a copy of the last one. So those are the 3 points at which big issue touch the process. But key to it actually is the quarterly meeting of the Social Advisory Committee. And the purpose of that committee is to review, advise and challenge everything that we do. But actually the social analysis, the analysis of the social intensity, the way that we go into the evidence-based approach, that's very much within the remit of Columbia Threadneedle. It's our fund. We manage the fund. It's not run by committee. And so this is an after the event kind of thing. Apart from the concept of advice, I don't want to go to that committee with a problem. If there's any contention about is this social or isn't it social, I have the ability intra-meeting to go and say, what do we think? Does it conform to one of these 8 areas of social outcome? Is it socially enough? Is it a net benefit enough to society to qualify as an investment for the fund? So I can lean, and I do lean on them where there is normally a contention as to whether it's social or whether it's not. That tends to be right on the edge, those kinds of credits there. The philosophy that we actually have for the fund is very much based on this idea that we're coming to it as an idea of a bond market's expert's way of delivering for society through the asset class that he knows. So when I described how we would go about it to big issue, I didn't know that this was called impact. I didn't know the concepts of ESG. I didn't know sustainability and ethical and all these acronyms and different ways of describing things. I just knew how my asset class could best deliver for society. Now, obviously, subsequently, I've discovered that this is, in fact, an impact fund. And actually, we are going about this in a different way to pretty much everybody else out there. And the reason is because I'm using the bond market to the best of my ability with my experience in order to try and deliver in the best way. That's why it's not an RI overlay or an ESG overlay. So what we have is basically a positive inclusion philosophy, not a negative exclusion philosophy. So don't exclude a few things and then just carry on as normal. But we do have minimum standards. So we do avoid alcohol, tobacco, things like that. But we do recognize that actually, in the case of alcohol, there's actually no problem with the product. The product is absolutely fine and in moderation can be quite beneficial in health terms. The problem is the abuse of the product, which creates tremendous problems for society. And so when somebody like Carlsberg has an aspiration to not only have ESG credentials, but actually to have a zero effect of their product on society, we're very interested and we engage and we go and find out what they mean by that, because that could be the solution. The effect of the product on society being the problem. As it turns out, all they're actually doing is providing a non-alcoholic alternative wherever they're selling an alcoholic product, which doesn't actually solve the problems of the abuse of the product to society. But nevertheless, we will engage. We'll even engage with the tobacco industry in terms of heat not burn and vaping and those sorts of things. Not that we'll invest, but we will investigate. So it's not excluding whole sectors of the economy and saying, I'm not going to go there, I'm not going to engage there, I'm not going to even investigate. So positive inclusion is very much a mindset and a philosophy. We then move on to an evidence-based analytical approach. It's very difficult, or so people tell me, to measure social, because they want to find a one-size-fits-all carbon footprint, carbon emissions, carbon transition, whatever the equivalent is in. They want a one-size-fits-all equivalent of the carbon element, the environmental element, the E to the S. Actually, there are lots of measures that are relevant and appropriate, and we will take any measure from wherever we can find it as long as it's appropriate, and we will build it into our process as evidence. So we have an evidence-based approach, and necessarily the evidence for an educational outcome is going to be different to a health outcome. But that doesn't mean that you can't build those evidence pieces into a very similar and structured formula for following the analytical approach through to the outcome that we can then deliver what we call a social intensity score. But what we are actually looking to do sometimes is we can't find the evidence that we want, the sorts of things that we're looking for. We have to engage, and engagement is the third pillar. We engage with companies. We ask the awkward questions that they're not expecting. They might be expecting us to ask what director's remuneration is all about, or the vice chancellor's remuneration for a university. They don't tend to be expecting the questions that we usually ask is, in terms of your employment credentials, how are you treating your catering staff, your cleaning staff, your maintenance staff? The vulnerable employees, those are the ones that we're focusing on. How have you treated them during furlough? Have you topped up furlough from 80% to 100%? Have you laid off staff? Are you paying a living wage? Are you training? Those sorts of criteria. So we're asking those kind of questions because that's part of the analytical process to try and find out those sorts of answers. So the three real pillars are positive inclusion, evidence-based approach, and the real engagement element. But the key thing with the bond market, you're a stakeholder. You're not an owner. So your ability to access management is greatest when they want something. And what do they tend to want? They tend to want money. So actually your access to management is normally best at the same time as your opportunity to achieve impact, i.e. through the new issue process. Because they want to sell their new issue, they'll engage with you, they'll answer your questions. And sometimes they say to me, why do I need to go to the time, the effort, the cost of providing all this information you want? And we will say to them, because we will score you on the quality and clarity of the evidence you provide. And if you get a better score, I'll buy more of your bonds. And if I buy more of your bonds at the margin, I'll lower your cost of capital. So it's an incentive-based approach, even down to the kind of impact statistics that we're looking for. But that's the point at which the new issue comes in. So we're really focused quite heavily in terms of impact on going for the new issue market. But we are a daily price, daily liquid fund. And so, of course, we buy secondary issues, but we talk more in terms of them being outcomes. So we talk about an outcomes-based approach, but we have an impact report and we are focused on achieving impact within the remit of the fund. So that's the philosophy behind it.
These are all investment grade bonds that you're going into.
These are predominantly investment grade, so we can buy up to 10% of high yield. This is a typical investment grade corporate bond fund with an average single A rating. But in any typical investment grade corporate bond fund, there is a small proportion of high yield that you can buy and contingent capital and those sorts of things. And the key thing about it is that we're focused in the UK social bond fund. 80% of the outcome, 80% of the impact needs to be domestically focused within the UK.
Right.
So we're focused on, let's say, Iberdrola, who issue a green bond. Iberdrola is clearly a Spanish company, Spanish domicile, Spanish head office. But the use of proceeds of one of the green bonds is 100% to fund wind farms off the coast of Norfolk in England. So the domicile might be Spain, the impact is the UK. So 80% of the impact needs to be domestically focused in the UK. And when we move on to the European Social Bond Fund, 80% of the impact needs to be within geographical Europe. We say geographical Europe because one political Europe in terms of Brexit is a little bit contentious, but it's because we're looking at the society of Europe. And that's not necessarily best defined by the politics of Europe. It's best defined by the people of Europe. And that is not changed by Brexit. You can't exclude Switzerland and Norway because they're not part of the EU. It's geographical Europe, the society of Europe that we want to benefit there. So those are the kind of the focus points, if you like.
So you started the UK Social Bond Fund, right?
Yeah, it was my idea. So yeah, indeed.
Okay. And you have this European Social Bond Fund, but then you also are responsible for Columbia Threadneedle's RI, responsible investment strategies across other asset classes. Columbia Threadneedle is huge. And where do you fit in the big picture?
I run 3 funds. I run the UK Social Bond Fund, launched in December 13, the European Social Bond Fund, April 2017, and in September 18, an Austrian pension fund that was invested in the UK Social Bond Fund said, I'm going to take the money out and I want to put it into a segregated mandate and I want you to go global. Do exactly what you're doing, but I want you to do it globally. So we now have a global segregated social bond fund. The total assets under management of those 3 funds is about $1.1 billion across those 3 mandates. In between times, in the US, in 2015, they launched a US social bond fund. So a year after they launched the UK social bond fund. But what, again, we're looking for is the effect. Mm-hmm. So how we do it is different. The effect should be the same. And you've got the great advantage of having the municipal bond market in the States. So if you want to fund schools and hospitals and those kind of things, you've got a municipal bond market to do it. So the US Social Bond Fund is focusing on the same kind of outcomes, but it's using the muni bond market, and indeed it's tax advantaged on the basis of, for US investors at least, it's tax advantaged. So it's a different way of doing it, but the aims are still the same, the benefits to society, etc. So that is around about, I think the last I looked was about $66 million. So the bulk of the AUM is in the 3 mandates that I run. The largest one is the UK Social Bond Fund, although the European Social Bond Fund is catching it up rapidly, depending on which currency you turn it into, but at least in terms of a dollar equivalent, it's catching it up rapidly. And I chair a meeting called the RI Construction Meeting each month. My job title is the Director of Responsible Investment Portfolio Management. So I'm responsible for portfolio management in responsible investment. So there is a separate research function, and obviously there are elements of the distribution and marketing side which are different. But in terms of portfolio construction, portfolio management, those kinds of things, what we're trying to do within that meeting and what I'm trying to do within my role is effectively challenge between the different asset classes and the different fund managers, idea generation between the different managers and asset classes, and sharing best practice. Those are the 3 elements of that particular meeting that we're trying to do. So we are involving our infrastructure team, we're involving our risks team, our 5P team, and indeed the other managers of what we are now calling category 8 and 9 funds, or in our own internal model 3 and 4. These are the most impactful or the most sustainable outcomes focused fund managers that will all get together and have a construction meeting amongst ourselves so that we can really hone down on the ideas of, if you like, the GYM group in the equity fund and pure GYM in the high yield fund. These are ideas that are very similar with, different companies, but it's effectively how can exercise and gyms, etc., and particularly that kind of pay-as-you-go gym concepts, that lower cost, not paying anything up front, how can that benefit the health of the nation and therefore contribute towards society? It's the same idea in the equity market through the GYM group is through the high yield market. And actually that's one of my high yield holdings in the investment grade fund. This idea generation and sharing of best practice and challenging of ideas is very important in the fact that we're all facing the same kind of challenges, opportunities within our own different asset classes. So I transcend all of that as well.
Threadneedle is involved in what we might call classic SRI for the exclusionary type of practices for years before you launching the UK Social Bond Fund.
We do build that into the way that we actually manage the impact funds, because when if you said to me, how do you go about the process of picking bonds, buying, assessing bonds, etc., first and foremost still has to be the financial criteria, because ultimately, if you get that wrong, if in extremis a company goes bust, you're neither going to deliver the financial return, nor are you going to deliver the impact. So it has to be the first consideration, which is the basic traditional financial rigor, the bottom-up fundamental stock picking that we're famous for, actually. You then move on to the second stage, which we describe as the ESG stage, which is effectively the internal management practices, what goes on within the four walls. We always talk about ESG as being doing the thing right, and impact as being doing the right thing. And if you do quote me on that, comes from, we've stolen that. I admit it fully. We stole that from PGGM, the big Dutch pension funds. We're looking at the internal practices. What are their environmental credentials, their employment credentials, their governance? How do they go about managing their business within their own four walls, etc.? That's the ESG stage, but we have a particular emphasis on controversies. So it's not necessarily the incidence of controversy that we're looking at. It's management's reaction to those controversies. Do they mitigate? Do they compensate? Do they make sure it's not going to happen again? And that, we feel, gives us a window into the culture of management. Because under pressure, how do they behave? Do they do the thing right? And if they do, then that gives us confidence that they're going to do the thing right going forward. And it's a cultural assessment, if you like. If they don't do the thing, we don't go any further, because we have got several instances where we don't like what we're seeing, we don't like the answers we're getting, etc. And so the ES stage is a fail rather than a pass. But that is, if you like, fairly traditional, but with an emphasis on controversies because of that more forward-looking cultural assessment that we can ascertain from that. And that's very much based on engagement. If there's a controversy, the first thing we do is engage. We don't just deal on press speculation, knee-jerk reactions, etc. We want to find the details, the evidence, how it affects particularly society, etc. So that's the second stage. And only if we pass those first two stages will we then go on to the third stage, at which point we drop from the company level assessment down to the bond by bond assessment, which is the impact stage. And that is where we are looking principally at the use of proceeds through the bond market and the good that use of proceeds is likely to do for society through the bonds that we're buying. And sometimes, and I say bond by bond assessment, if I give you an example of NatWest issued 2 social bonds, ICMA branded social bonds, use of proceeds specific towards, in the first instance, SME lending in deprived areas of the UK. So addressing deprivation, additional lending, the kind of elements that we're looking for are, is there additionality, additional services, additional infrastructure, etc.? Is it tackling a deprived community within society? Might be the young, might be the old, it might be the disabled, it might be displaced persons or refugees, it might be areas of deprivation geographically within the country, as is the focus of the NatWest social bond. But the second social bond they issued was doing something completely different. That was funding lending to affordable and social housing providers. So actually, same issuer, same structure, they're both social bonds, completely different outcomes. You have to do a bond by bond assessment, which is real heavy lifting for the poor old social analysts that we've got. But those are the 3 stages that we go through. And even then, I've got to look at the portfolio and say, this additional bond that you've just analysed, that's passed the financial, that's passed the ESG and controversy, and actually we've determined the social intensity, it still might not fit in the portfolio because it might not be a good fit. It might be not what I'm looking for. I might have something better already, etc. So it's a way of filtering down a large number of bonds into more likely ones that are going to do good for the portfolio. But the real heavy lifting, the real hard work, granular assessment occurs with the impact, the responsible investment analyst's impact assessment.
Are all of these use of proceeds ring-fenced in all the bonds that you invest in?
No, that's the difference between the fund that I'm running and, let's say, Amundi, who've launched the Global Social Bond Fund, where I believe, you'd have to check this up, but I believe that they will only buy ICMA branded social bonds. This is not an ICMA compliant social bond fund. This is a bond fund that is aiming to do good for society. So we will buy general corporate purpose bonds. We will buy green bonds with social benefits. Let me give you an example. Transport for London issued a green bond and it had its environmental credentials and we engaged with them. And I said, actually, you're regulated to be green. You have to be green. It's not really adding anything. There's no additionality here through issuing a green bond. Where the additionality occurs is the fact that I know that the use of proceeds is towards, at the time, it was to build the cycle superhighway in London. It was to buy more Route Master buses. It was to upgrade ticketing offices and generally upgrading the tube network, i.e. additional infrastructure in a crowded, populated, polluted, at the time, capital city, which was very much beneficial to society in terms of the provision of transport infrastructure. And I said, your additionality, your additional benefit through this bond is social. Came back to me and they actually gave me a whole load of evidence to that effect. And then said, but we're still going to issue a green bond because we know there's demand for green bonds and we want to issue a green bond and we want to be showing that we're green. But actually, that's a really social green bond. You might say to me, what's a green bond that's not social then? Actually, Unilever issued a green bond that was basically use of proceeds to make more efficient ice cream cabinets for their ice cream. Now, I'm sure that's good for the environment. We want more efficient ice cream cabinets, lower energy, etc. Is it addressing a deprived community within society? Is it really satisfying a need for society? I wouldn't say that ice cream is an absolute essential, is it really? So we would regard something like that as being, yes, it's a green bond, it's beneficial environmentally, but it's not a green bond with social benefits. So that's the way that we look at things. We don't actually care the structure of the bond over and above the fact that actually it's helpful that we know the use of proceeds with the green bond because it is ring-fenced use of proceeds. And actually with the campaign that we launched in May 2019 for the Green Gilt, which I spent an awful lot of time, particularly in the back end of last year with the Grantham Institute, the Green Finance Institute and the Impact Investing Institute on their working party. One of the concepts there was the fact that we called it initially when we presented it to the government, the Green Plus Gilt. That referred to the fact that we wanted, yes, environmental projects, yes, building back better, green jobs, all those kinds of things. But actually we wanted the reporting to reflect not just the environmental credentials, but the social co-benefits. We've now managed to embed that within the new latest published Green Bond Principles. So the Green Bond Principles now recommend that in terms of reporting, you also report the social co-benefits even of a green bond. So that kind of concept that we started with the Green Gilt, we've now built into our work that we do in subcommittees in ICMA for the Green Bond and particularly the social bond principles. So we will take any bond of any description, if we can identify the good that it does for society and analyse that and use the evidence that we find to prove that, then we will buy that bond.
You've mentioned the big issue a lot. You mentioned earlier that they walked in the door and I think you somehow partnered with them. Why was it important for you to partner with them? I just want to get that clear in my head.
Yeah, we believe in the partnership model. At the end of the day, Columbia Threadneedle are well known for their financial acumen. We're well known as, Minneapolis, Boston, London, our financial credentials go before us. We're not known for, and we wouldn't claim to be experts necessarily in social. So if you're launching a social bond fund, we believe in the partnership model because what Big Issue bring above those three areas they touch the process that I've already taken you through, they also bring their expertise and their reputation to the product. We've got a history of a partnership model. So we've got a low carbon workplace fund where we partner with the Carbon Trust. In the European Social Bond Fund, we've got a different social partner, but nonetheless, we've got a more pan-European social partner. We've also brought on board into the social advisory panel for the European fund, Oxfam, as a much more international perspective on things. So we're trying to bring in expertise, reputation, those kinds of things on the social side, because we recognize that we bring all the credentials on the financial side. We need something to mirror that. As I've said before, everything we do on the financial, we're trying to find an equal and equivalent process or resource that matches it on the social side. So that's really the idea. We believe in the partnership model because we want to recognize what we're good at and we want to recognize what they're good at. And if you're launching a social bond fund, it's absolutely essential that you have somebody that's good at the social and gives you good advice, and their reputation gives them real skin in the game.
Yeah. What is the work that they're doing that's important to you?
The three areas that they touch the process, setting the 8 areas of social outcome was them. Sitting on the social advisory committee regularly on a quarterly basis is where they probably interact with us most often, and indeed interact those meetings as well. If we have a problem, is it social, isn't it social, we can go to them. And the third area, and probably the most productive output of their expertise, is that they will produce, separate to us, independent to us, an independent impact report on the fund, which comes out based on the data on the 30th of June every year. And so that's public information. You can go and read that. I think it's a 68-page report for the UK Social Bond Fund. Have a look at that, because that's really where the impact of the fund comes to life. And they will shed a light on the fund and the portfolio, in addition to the way that we manage it in terms of the evidence-based analytical approach, the social intensity scores. They will look at it from different angles in different ways as well. So they look at the place-based investment angle, how much of the portfolio is focused on areas outside of the greater southeast, the more deprived areas, etc. What are the jobs criteria? They use their own proprietary process called JAM. It's a job index based on the sectors that we invest in, jobs intensity, that kind of thing. So a lot of what they're doing is actually in that impact report, in terms of actually reporting on the fund and being an independent voice on the fund on behalf of, and to report to investors. I always talk about the impact report. It's my end of term report. It's like being back at school again. And the report doesn't go to my parents. The report goes to my investors. So that's what it feels like.
Right. You've really developed this social assessment methodology step in step with them.
We developed the UK methodology with them. We've then gone on and developed similar, but to the next generation of methodology with the European social bond funds. We've also kept it fresh, kept it moving. So what we also do in terms of what we're looking at, we map each and every bond to what is now becoming the common language of sustainability, which is the UN SDGs. In fact, we don't map to the 17 UN SDGs, we map to the 169 targets that underlie the 17 SDGs, because they're much more developed market relevant and actually much more specific by doing that. But that's the common language for sustainability. And also it becomes a bit like a Sharpe ratio. And, this is the equivalent. The financial side is the Sharpe ratio, the risk adjusted return. You can compare an equity fund manager, a fixed income fund manager, property fund manager, but it needs to be based on a Sharpe ratio. SDGs, you can do the same. You can compare your equity fund manager, direct lending, property, whatever, using SDGs on that sustainability common language. So, of course, we map each and every bond to those, but we still focus on our 8 areas of social outcome. Equally, on the impact side, we're also starting to adapt the impact management projects methodology. They're A, B, C. So A, act to avoid harm. B, benefit stakeholders. C, contribute to solutions. We're mapping each and every bond to that criteria because we think that might develop into the common language of the impact community. So we've got the sustainability common language, we've got the impact common language, and then we've got our own 8 areas of social outcomes, social intensity, those sorts of things. So we're trying to forge ahead, be pathfinders, cut through the undergrowth, and hopefully others will then follow.
From a portfolio construction perspective, correct me if I'm wrong, but I think that you divide your exposures into 3 buckets, a high, medium, and low social intensity bucket. Am I correct on that?
Well, in terms of portfolio construction, there are 3 things that I'm doing, but actually they're different 3 things than the ones you've mentioned. That's just one of them. So the 3 focuses for portfolio construction are social intensity, the yield, the return, because you should get the return for the risk that you're taking. If you take a corporate bond risk, you should expect a corporate bond return. This is investment. This is not philanthropy. It's not altruism. It's not charitable endeavor. It's investment. So you should get the return for the risk that you're taking. And the third is liquidity. We're using the liquidity that the bond market provides through trading to be able to provide a daily liquid, daily price fund. Because one of the preconceptions that people have of impact investing is that it's illiquid, that it's putting your money away for a long period of time, that don't have access to it, and also that it's edge of market stuff. So all these elements, we're trying to disavow people of their preconceptions. So you should expect a return. You're not sacrificing financial returns. You should be able to have liquidity. You should be able to put the money in today and take it out tomorrow if you need it. That's what the fund is providing. And this should be mainstream. What we're trying to do here is put responsible investment into the mainstream. So essentially, this is just a corporate bond fund. It might be approaching it in a completely different way, but ultimately it's a corporate bond fund. It's what I've been doing for 30 years. So those are the 3 areas in terms of portfolio construction. Within what we're talking about in terms of the delivering for society and the optimization of social outcomes, we do. The result of the analytical process from our responsible investment analysts is to categorize high, medium, and low. And also the social advisory committee give me a target as a fund manager. I've got targets on the financial side. I want to give you the return that you should expect for the risk that you're taking. Outperformance targets, used to those throughout my life. I should have something equal and equivalent on the social side. The social advisory committee expects me to deliver a portfolio that is broadly a third, a third, a third. And the reason that they allow me to have a third in low social outcomes is because, one, they're still doing good. They're net positive for society. These are not bad social outcomes. They're good. They're just not as good as medium or high. The second is that they recognize the fact that I've got these other two criteria to fulfill as well. I need to provide for the financial return for the fund, and I need to provide for the liquidity that the fund represents, and indeed all the elements of diversification and to make it look and feel and smell and perform just like a typical corporate bond fund. I need lower social outcomes in order to be able to furnish that. However, you give a fund manager a target and he tries to outperform it. So one of the things I show in terms of are we delivering social alpha, not just what the market is giving us, but actually social returns over and above, is by outperforming those targets. So I don't have 33.33% in low social outcomes. I've got currently 16.7% in low social outcomes, which means I've got much more in high and medium. That's one way of proving that we're outperforming on the targets that we're given by the Social Advisory Committee.
What are you benchmarking against?
Originally, we were benchmarking against the peer group because we said we don't have any peers, but this is a corporate bond fund, so we will measure ourselves against all the other corporate bond funds out there. But then, I think it was April 2016, we changed to a benchmark itself. So rather than a peer group comparison, we changed to a benchmark because we were approached by investors who wanted to preserve capital. And so we have a shorter duration. In fact, it's the Merrill Lynch 1 to 10 year non-gilt index. The reason that we've got the non-gilt index is because that index does contain agencies, supranationals, local authorities, those kinds of things that are over and above corporates in their own right. And we recognize that they are doing good for society. The 1 to 10 year area gives us about a 4.5 year duration and therefore protects capital for investors much more, which is what they said they wanted. But we nevertheless don't restrict our investments to just 1 to 10 year bonds. We will buy 30-year housing associations, 40-year universities, utilities at the long end. What we will do is we will optimize the social elements of what the bond market in its whole provide us, and then we will sort out the financial implications of that by using derivatives, etc., by shortening the duration, paying fixed at the long end in 30-year swaps, or using the long gilt future to then manage that duration down to the target duration.
But are there any risks to investors that are unique to your fund, apart from what a traditional bond fund investor would be exposed to?
I wouldn't say risks, but we clearly have a style bias. Investors are used to style bias. You know, whether you're in the equity market, whether you're growth or value, people have style bias. Our style bias is social. So effectively, when the oil and gas companies do well and their bonds tighten, we're going to underperform. And when tobacco companies do well, we're going to underperform. When brewers do well, we're going to underperform. But when housing associations do well, when utilities do well, when, you know, perhaps even social bonds do better than conventional bonds, maybe, then we'll outperform. There is a style bias to being social. And actually what that translates into in reality is actually a little bit more of a conservative portfolio in the fact that we are social. So the purpose is to be social. The consequence is that we recognize that we're a little bit less cyclical and we're a little bit more conservative in the types of bonds that we buy by being social. And so the way that we address that is we build a little bit more beta into the portfolio, etc. We recognize the fact that because we haven't got tobacco companies and they're non-cyclical, we'll buy a few more utilities, which are also non-cyclical. We would try and mitigate all of the risks that you'd expect, but we are still left with a style bias whereby if the pub companies do very well, they've done very badly last year because of the pandemic, there will come a point where the pub companies will do well. We don't buy companies. So at the end of the day, that's the style bias.
Can you provide me with a couple real world examples of investments that, you know, really nicely demonstrate how they fit your mandate?
Now, one of the things that the big issue asked us to do right at the very start, they wanted to establish the market for charities to issue in the bond market, and they wanted to re-establish a market for local authorities, which even when I came into the market, we had local authority issuance. We had Salford and Dudley and NEC guaranteed by Birmingham. I can reel them off from my early days in the market. But one of the things that we wanted to do is establish a market for charities to buy bonds. And Canaccord and Alia set up the retail charity bond platform in the early days of the fund in order to enable charities to issue bonds, retail charity bonds, as they were called. So we already had housing associations, which invested in the institutional bond market, which are charities and Wellcome Trust and people like that. But for the small and medium-sized charities themselves, it's more difficult. So the facility to be able to provide some pro bono fee benefits, etc., lower the bar, the cost bar of issuance, etc. And we participated in a few of those. Golden Lane, Hightown Housing, which actually is a housing association, but Golden Lane is MenCap's housing arm. So it provides housing for MenCap, the charity, the mental health charity. But the one I really would highlight, because there's a little bit of a story to this one, is the Charities Aid Foundation. So the Charities Aid Foundation we knew, and they actually used to coordinate our giving within Threadneedle. Actually, when the fund was launched, they would provide our Give As You Earn policy within Columbia Threadneedle, and I had a charity account with the Charities Aid Foundation. But they came to us as prospective investors in the fund, and so I presented the UK Social Bond Fund to John Lowe, and he has lots of cash there. The Charities Aid Foundation is pretty cash rich. And he liked what he heard, et cetera, et cetera. And as part of my presentations, I always say to people, that, look, I'm looking to grow this market, encourage this market, provide advice and do things to help originate the types of bonds that we will actually eventually put into the portfolio. If you need any advice, if you need any help, let me know. And their own decision, they decided not to invest in the fund. However, 6 months later, he rang me up and he said, Simon, you said you wanted to provide advice. We're thinking of recapitalising our charity bank that we own as Charities Aid Foundation. And I'm thinking of doing a loan. I just want your advice on how you would see that kind of thing. What sort of considerations we should bear in mind. And I said, well, John, the first thing I would say to you is don't just think in terms of doing a loan. Go and talk to Canaccord and Alia and go and talk to them about the recently launched retail charity bond platform and think about possibly widening your investor base and giving me the opportunity to invest through the bonds in what you're doing through the charity bank. We had our conversation, the whys and wherefores, how he saw opportunities to grow the bank and the sorts of things it was providing loans to small and medium-sized charities, etc., and the services that they were providing. It was a very nice update, etc. And I heard no more of it. And then a year later, he rang me up and he said, Simon, I'd like to invite you to the roadshow of our inaugural retail charity bond. I said, oh, John, where did you hear about that? And he said, Simon, a little bird told me. And so I went and saw the roadshow. It was launched, retail charity bond. It had a 5% coupon, really good return. We did the analysis. It was to fund the charity bank. The great thing about that is it gives us access through that on lending to the types of small and medium-sized charities that wouldn't be big enough even to issue through the retail charity bond platform. So it gives us access to people that wouldn't normally, you wouldn't normally expect to have access to the market, but we necessarily now start to reach those kinds of charities and the works that they're doing through the on lending. But then I was invited to, they launched pressed the bell for the London Stock Exchange one day, and I'm in the background of the picture and signed the book and all that sort of thing. And we got a good allocation, etc. But the key thing to that is it's an example of a new sector which we were starting to form as a result of supporting that through this fund. It was also something that we had a hand in originating, and that kind of engagement that we had generally actually resulted in a bond that we could put into the portfolio. And it was a really good bond. It had a high set level of social intensity, had a really good financial return. And actually, through the retail charity bond platform, it's not that illiquid. It's quite volatile, but it's not that illiquid. So actually, that's a nice little exemplar of the sorts of things we're doing. The other one is NatWest, I suppose. You could talk about their two social bonds and the fact that I sat down with them and told them how they could do it better. And they came up with a bond that was different to the previous one and was accessing social housing and affordable housing, etc. HSBC is a good one. Again, banks themselves provide the opportunity through the on lending to access small and medium-sized companies that wouldn't be normally big enough to issue into the bond market. So we can do that as long as it's specific use of proceeds. So HSBC issued an SDG bond, and that was targeting 7 of the SDGs. It was an ICMA sustainability bond structure. So it conforms to the green and social bond principles. But we didn't know where the money was going. HSBC is a very international bank, and we want 80% of our outcomes to be UK. So we assumed it was the 20% outside of the UK because it's HSBC. And so I actually stood up in front of 200 of their salespeople in Canary Wharf in London and said, your impact reporting needs to be blooming good when you produce it in a year's time, because I really don't know where the money's going. We don't really have the evidence to assess this properly. And then a year later, in fact, it was 13 months later, out comes the annual impact reporting for that bond. And then we knew that 49.8% of the money was going to the UK. So we had to, because half is our criteria, we reassessed it as a domestic investment. We then knew that of the SDGs, actually the top SDG relating to social housing and shelter was actually promoting better social intensity. We now knew what proportion those 7 areas of social outcome were coming out at. And indeed, their impact reporting was much clearer and much more precise because we've now got the impact report. So in consequence of that, and this is a dollar issue, well, NatWest was a euro issue. So we're buying foreign denominated bonds that nevertheless have in both those cases UK outcomes. So we're taking the whole of the bond market. But the great thing is that as a result of HSBC, I always say to companies who say to me, either we can only include loans that we've already dispersed, that have already done their job, already been benefiting society because we can measure them, or indeed that actually we need to look back over 2 or 3 years. I always say to them, take a basic scientific principle, set out your criteria for success or failure at the start of a project or at the start of, in this case, a bond issue, and then measure yourself against that criteria going forward. So your reports on an annual basis should be measured against this thing. And then what we can do is we can give you the benefit of the doubt. We can hold you to task in terms of delivering or under or outperforming that, but at least then we can get more embryonic, more early stage loans that will then benefit society going forward, rather than including stuff that's already been done, projects that have already been completed, loans that have already been dispersed, which have already done their work. We want to see benefits going forward over the life of the bond, not including stuff that's already been done. So that is very much part of the story around HSBC and what they should have done and how we would advise people to do better.
You're focused on outcomes as opposed to outputs. I think we can't have the conversation these days without bringing up the term greenwashing, which maybe isn't exactly pertinent. Is that a thing in social impact investing or not?
I have heard the term social washing, and I've also heard the term rainbow washing or SDG washing. Because of those coloured boxes, it gets called rainbow washing. So I think if we talk to you about what we're doing, and what we're doing about that is, despite the rigour that we have behind everything that we do and following the money through and have some clear criteria, no more than 2-year look-back periods, those sorts of things, what we're doing is actually within ICMA, within the Green Bond and Social Bond Principles, the work that we're doing there. And some of the things that we're doing, one of the ideas that we've got that is now becoming a recommendation is that we've got the concept of a second party opinion and of verification generally, but it tends to be verification that the process has been followed and the disbursement of the monies has gone to the right kind of projects. What we're now introducing is the concept of confirmation as well as verification. So we're looking for normally a sample survey of the target population so that we can ensure that the people that we hope will be benefiting from the disbursement of that money in the right areas are actually benefiting. So we're looking to encompass that as a form of reporting. So this was actually done through the Social Bond Working Group Subcommittee on Impact Reporting, but actually it applies for social bonds and green bonds and indeed sustainability bonds, which we'll be targeting both. But this concept of not just verification, but moving it on to confirmation. I've actually seen a social bond framework that actually does encompass that. So there is survey evidence of the target population. Unfortunately, they haven't actually issued the bond yet. So I can't give you the example, but we've complimented them on actually implementing confirmation concept within what they're doing. So what we're trying to do is make sure that we get the robustness in the structure of the bond itself and allay those fears of greenwashing within the structure of the bond, so that actually if you are trying to do good for the environment, let's survey the good that you're doing from the target population. Or if you're trying to create green jobs or you're trying to benefit, I don't know, women in the workplace or women-led businesses through gender bonds, let's have a survey of just a sample survey of the beneficiaries, and let's have confirmation of the impact. But the other concept of greenwashing is, of course, is it actually doing any good? Is it adding anything? Is it benefiting more than would have happened already? So that is very much, I've already mentioned it to you, haven't I? The 3 things we're looking at: additionality, focus on deprivation, and quality of impact reporting. Those are the key fundamental areas that the analysts are really looking for in order to determine the social intensity.
You say that you think sustainable investors can have their cake and eat it too in terms of return and impact. But lately, there's been some oversubscriptions, a high amount of demand that can lead to issuances being priced with the lower yields, consequently diminishing returns to sustainable investors. Is that okay?
It's the invisible hand of the market at work. It's Adam Smith. So if you are having a greenium, a green bond that has a lower yield than a conventional bond from the same issuer, you are sending a message through the markets to the companies that are issuing these bonds in terms of these defined projects being more palatable, let's say. But actually, in my world of social, we don't have as much of a problem. If you break down the green sustainability and social bond markets and the issuance patterns, you find that there's a lot of supply and demand at work. So a lot of shift in responsible investment is into the environmental side of things. So there's a lot of funds, a lot of fund managers and a lot of clients that have moved into the environmental, meaning that demand for environmental has gone up substantially. Issuance for green bonds last year was up. In fact, at one stage around about this time last year, green issuance was down last year. And yet demand was still going up and up and up all the time as people started to shift into this. In the end, we ended up 25% up on green issuance last year. But there's a lot more demand than the growth of 25% would imply. With social bonds, we had over 900% increase in issuance of social bonds last year. And we know that the people, whilst they're incrementally moving from environmental possibly into encompassing some social elements, maybe sustainability, there aren't too many social bond fund managers like me and like Amundi. So actually the demand for the bonds in social is not driving the yields down below. And what the real panacea for me is that I can buy, let's say, a bank who might issue a green sustainability and the social bond. And they'll probably issue the green first, then the sustainability, and then they might issue a social bond. And that's the way the market moves. We had green bond principles, then we had social bond principles, people moving into the green market, and then they start to move into the social market. So what you're seeing actually in terms of new issue premiums is you can move out of a green, and particularly the secondary market in green bonds is where they trade through the curve. So actually that is a panacea because you can buy a green bond that it might be on the curve, it might be even there's a slight negative to the curve, but in the secondary market, it trades further through. So that's a great thing for a bond fund manager, to buy something on the curve that you think is in the secondary market likely through demand to trade through. That's great, particularly an active manager like ourselves. So even in the green bond market, there are opportunities to actually add value through doing that. But in social bonds, you can move out of green bonds, particularly those that have now performed and are trading in the secondary market, and you can buy a new issue in the social bond market, which actually will come north of the curve because there isn't that demand yet. The demand is coming, but the supply has already come first because we've had a pandemic and we've had response to that pandemic and over 900% increase in ICMA branded social bonds. And if you annualize this year's issuance, another 49% increase this year as well. A hell of a lot of demand, a hell of a lot of supply of social bonds coming, which means you get good value. So I can move out of something that's trading through the curve, even from the same institution. So I can sell RBS's green bond and I can buy RBS's social bond, and I can actually add even more value because I'm buying something wide of the curve and I'm selling something through the curve. So there are still opportunities. What active fund managers want is they want opportunities. They want the ability to be able to trade. They want the ability to reap the rewards of active management. So a passive manager, buy and hold manager, somebody like that, an index tracker manager, they're perfectly happy with something that's, no volatility, stable markets, all that kind of stuff. Active managers come into their own when you get opportunities, when you get anomalies, when you get the ability to really add value. And the fact that something is trading differently to something else, to an active fund manager, that's an opportunity. So I would turn it on its head. And I would say the fact that we do have greeniums and perhaps we have wider spreads from social bonds and perhaps different sectors have different forms of issuance. And there is always this concept, actually, that if you issue a green bond, actually all of your bonds do better. So it's not just quite as simple as saying it's green bonds that are driving the market. And actually, that's the signal that the market is providing. There is anecdotal evidence from, in fact, I think it's empirical evidence, funny enough, from HSBC, although not a particularly wide survey, but there is evidence that there's this halo effect. So an issuer of similar quality and in a similar industry that issues a green bond gets the benefit of the reputational element of that green bond relative to another issuer that doesn't issue a green bond, and all of their bonds, general corporate purposes and not, all do better. So it makes a market. I'm an active fund manager. This makes a market and this provides opportunities. We're talking about the difference between beta and alpha. So whilst I focus primarily on social alpha, I still try and take all the chances I can to deliver financial alpha as well. So those kind of opportunities of active management present themselves and I take them.
Do you think, though, the social investment market will catch up with the growth at the ESG equities and green bonds?
Yeah, not only do I think so, I hope so. Because there are so many more projects, there are so many more challenges for society if you encompass social issues as well. And don't get me wrong, if we get the environment wrong, it's going to create tremendous social problems. So you can't separate the two. Last year was the rise of social. This year is the coming together of environmental and social, so that you can't really separate the two. And by the way, if we do get the environment, it's going to cost an awful lot of money to get to net zero by 2050. And we need to make sure in this society that the cost of doing that is not borne by those in society least able to afford it. Yeah. So there's social and environmental, and there's environmental and the social. You can't necessarily have this nice, easy world of saying there's an E and there's an S and there's a G. You've got to look at it as a whole. Yeah. But yes, I do think social will, and I hope social will follow the track that we've seen with green bonds. That's what we're seeing at the moment, albeit with a shot in the arm, and pardon the pun of a shot in the arm for the pandemic that we've just seen, but with the shot in the arm that we've seen from this widening of perspectives through a social crisis that is the pandemic, which has affected social issues like health, education, employment, nothing that we've seen for the last 300 years. This is almost like a war. It's a health war, if you like. But boy, has it widened people's perspectives and looked at social issues as well as environmental. That's why we've seen 900% increase in ICMA branded social bonds last year.
Well, listen, I know you've got to run to another meeting. I think it's amazing work that you're doing. It's pioneering work. You're starting that fund. You're doing more than just the average fund. There's a lot more thought to it, the way you've partnered, the big issue. It's been a great pleasure to meet you. Thank you for your time and for participating in this. We'll be in touch.
Great. Good luck with the work.
Yeah. Thank you very much. Cheers.
If you enjoyed this podcast, please do me a favor and hit the like button and subscribe to receive future episodes. You can find more interviews, articles, and information on sustainable and responsible investing at our website, sri360.com. If you enjoyed this interview and you would like to read more lessons learned from world-class SRI investors, get yourself a copy of my book, Sustainable and Responsible Investing 360 Degrees. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 Degrees is now available in hardcover, ebook, and audiobook format wherever books are sold.